Hey everyone, welcome back to the Capital Breakdown. Today, we're tackling a topic loaded with myths and wishful thinking, beating the market. You've heard the stories of investors who supposedly outperform year after year and wondered, could that be me? Here's the truth. Almost no one consistently beats the market over the long haul. It's not just tough, it's rare. So if beating the market is nearly impossible, where should you focus your energy? That's what we're unpacking today, the real deal on active versus passive investing. What market returns really mean day to day, and how to set yourself up for financial success without chasing a long shot. We'll look at the numbers, bust myths, and give you practical advice to use now. Let's dive in. First, what does beating the market even mean? Usually, it means earning higher returns than a broad benchmark like the S&P 500, an index tracking 500 top US companies, over a certain period. Sounds simple, right? But the market is a massive, diverse mix of companies growing, shrinking, innovating, or sometimes failing. Outperforming that collective means picking winners and avoiding losers, way harder than it sounds. Imagine running a marathon against thousands, but you only get one shot per year to place near the front. Even pros struggle to consistently finish ahead. Plus, the market reflects the collective wisdom of millions of investors, institutions, and algorithms, a tough opponent. So beating it means you're consistently smarter and luckier than the entire market's combined brainpower and capital. That's no small feat. Now the two main camps, active and passive investing. Active investing means you or a manager try to pick stocks, time the market, or find the next big thing, like a coach selecting star players for every game. Passive investing is buying and holding a broad market index fund or ETF, buying the whole team and riding its overall performance. Think of it like buying a big fruit basket instead of hunting the juiciest apples, oranges, and berries one by one. You get the market's overall growth without betting everything on a few picks. This difference matters because the math explains why many active investors fall short. Active investing often means more trading, higher fees, and bigger risks, all eating into returns. Passive investing rides the market's growth and keeps costs low, making it a powerful approach for many. Here's the math. Active investors pay higher fees, trade more, and sometimes take bigger risks. Those costs cut into returns. Imagine slicing a pie. The bigger the fees, the smaller your piece. Plus, when one investor beats the market, another falls behind. It's basically a zero-sum game before costs. After fees and expenses, over 80% of active funds underperform their benchmarks long-term. That's a reality check. Even top stock pickers struggle to beat broad indexes after costs and taxes. That's why many experts recommend passive investing. It's a statistically smarter bet. Imagine playing poker against experts while everyone pays a rake to the house. Winning is tough, and the rake eats your winnings. So why do some active investors seem to beat the market sometimes? Often it's luck, timing, or a few big wins that grab headlines. Someone might have invested early in Apple or Amazon and ridden huge gains. The market is noisy and volatile, so occasional big wins can look like skill, but those come with higher risk. It's like gambling at a casino. Sometimes you hit the jackpot, but over time, the house usually wins. Risk is the wild card. Chasing big returns without understanding risk can lead to big losses that wipe out gains. Also, beating the market 1 year or a few years doesn't mean you'll do it forever. Consistency over decades is the real test, and that's tough. Don't be fooled by short-term success or flashy headlines. Focus on steady, sustainable growth that fits your risk tolerance and goals. Diversification is another key piece. Spreading money across many investments, stocks, bonds, sectors, geographies, lowers the risk of one company or event tanking your portfolio. If you invest only in one company and it goes bankrupt, that's disaster. Active investors often concentrate on a few stocks, upping risk dramatically. Imagine betting your savings on just a few horses. The payoff might be big, but losing is more likely. Passive investing through index funds or broad ETFs naturally diversifies, smoothing ups and downs. It's not about avoiding risk. All investing has risk, but managing it wisely. Diversification is like eating a balanced diet instead of just one food group. It keeps you healthier long-term. What about market returns? Historically, broad stock markets deliver average returns around 7 to 10% annually, adjusted for inflation. That might not sound like a jackpot, but compounding those returns over decades grows your money significantly. Think of planting a tree. It starts small, but grows bigger, producing fruit year after year. The key is staying invested, letting gains build on gains, and resisting the urge to jump in and out based on emotions or headlines. The market's daily ups and downs can be nerve-wracking, but time in the market usually beats timing the market. Patience and discipline often matter more than trying to beat the market. For example, staying invested through the 2008 financial crisis and 2020's COVID dip would have led to full recovery and growth. Missing just a few best market days can seriously hurt returns, so staying the course is key. So should you give up on active investing entirely? Not necessarily. Some enjoy the challenge, have time and knowledge to research, and can handle the risk. It's like choosing to cook your own meals instead of eating out. Effortful but rewarding. But if you want steady growth without watching the market constantly or guessing what's next, passive investing is a solid base. It's like choosing a reliable car for your financial journey instead of a flashy sports car that might break down or need costly repairs. The goal is sustainable wealth building and avoiding costly mistakes. Remember, neither approach guarantees success. Risk and uncertainty are always part of investing, but having a plan and sticking to it improves your odds. Now, practical steps if beating the market isn't your goal. First, clarify your financial goals and time horizon. Are you investing for retirement decades away, a house in a few years, or short-term needs? Your strategy should match your goals and how long you plan to stay invested. Next, build a diversified portfolio fitting your risk tolerance, spreading money across stocks, bonds, maybe real estate or alternatives, to balance growth and stability. Keep costs low. High fees can drain returns over time, like a leaky bucket losing water. Look for low-cost index funds or ETFs and watch expense ratios. Lastly, consider tax efficiency. Tax-advantaged accounts help your money grow more effectively. Another smart habit, automate your investing. Set up regular contributions, monthly or quarterly, no matter market ups or downs. This dollar-cost averaging reduces risk of buying at the wrong time and builds discipline. Imagine buying pizza slices over time instead of the whole pizza when it's expensive. Also, resist checking your portfolio daily. Constant monitoring can lead to emotional decisions that hurt returns, like selling low after a scare or buying high in a frenzy. Instead, review investments periodically, once or twice a year, and rebalance if your allocation drifts. This keeps risk in check and your plan on track without stress. Think of it like tuning your car regularly. You don't check the engine every mile, but scheduled maintenance keeps it running smoothly. Let's talk risk management. Investing always involves risk, not just stocks. Bonds can fluctuate, real estate markets can cool, and new assets like cryptocurrencies have ups and downs. Diversification helps, but no strategy is risk-free. That's why understanding your risk tolerance is crucial before deciding your portfolio mix. If big drops keep you up at night, a conservative mix with more bonds or cash might suit you. If you're younger with time to recover, a higher stock allocation can capture growth. Know your limits and avoid chasing returns that make you uncomfortable. Risk management is like wearing a seatbelt. It won't stop accidents, but it protects you when things get bumpy. Finally, education and guidance matter. Investing can feel like a foreign language. Words like alpha, beta, expense ratio, yield can confuse. Learning how investments work, what fees mean, and market behavior empowers better decisions. The Capital Breakdown is here to help you grasp the basics and beyond. But nothing replaces personalized advice from a qualified professional who knows your unique situation. Always do your research and consider consulting a financial advisor before big moves. This episode is for education only, not personal advice, but we want you confident and in control. Think of education like sharpening your tools before a project. Better prep means smoother work. To wrap up, beating the market consistently is extremely hard, even for pros with teams and resources. Instead of chasing elusive outperformance, focus on what you control: your time horizon, diversification, costs, and discipline. Think of investing like planting a garden. You can't force plants to grow overnight, but with steady care, the right environment, and patience, your garden will flourish season after season. Water the seeds, give them sunlight, and watch your wealth grow. That's the real power of investing. Thanks for joining the Capital Breakdown, where we turn big financial ideas into clear, actionable knowledge. Stay curious, keep learning, and remember, your best investment starts with understanding. See you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.